Let's jump right into this explainer. Today, we're tearing down that whole get-rich-quick illusion and looking at the actual anatomy of a funded professional trader. And we're zooming in on a very specific high-stakes scenario, passing a $5,000 prop firm challenge. If you're dealing with a strict 2% daily loss limit, which, let's be real, is literally just $100, and a tiny 3% max loss of $150, especially when you're trading a beast like gold, standard advice is just going to get you wrecked. We absolutely have to take an extremely conservative, data-driven approach, or protecting your capital is the name of the game.
Now, this quote hits right at the painful truth of why so many traders blow their accounts in week one. When your margins are this razor thin, like that 3% total loss limit we just talked about, your edge is absolutely not about predicting where gold is going to go next. Honestly, it's about your rock-solid discipline to protect your account when the market inevitably starts moving sideways.
So, to get you consistently profitable, we're following this exact blueprint. First, the retail trading trap. Then, we'll hit smart money concept essentials, the precise mechanics of an entry, the seatbelt of risk, and finally, mastering your trading psychology.
All right, part one, the retail trading trap and why most people fail. You know, retail logic constantly pushes this idea of risking big to win big, chasing those crazy 100 to 200% annual returns. But think about it. In a 5K prop challenge, if you use the standard risk 1% per trade rule, literally just 3 bad trades in a row will blow your entire account. No way, right? Institutional logic flips this entirely. It's all about playing defense first, aiming for a realistic 20% by waiting patiently for strict market confirmation. But man, the temptation to ditch that defense is so real. I mean, when you see mind-blowing numbers like this $936,000 payout that prop trader DC pulled off in just 25 days, it's incredibly easy to let greed take the wheel. You suddenly stop seeing the market as a probability matrix and start treating it like a Vegas slot machine. So the real question here is, how do you actually survive the markets long enough to let a statistical edge play out? Because let's face it, you can't manifest any kind of edge if you get kicked out of the game by day 2. Your number one job right now isn't rapid growth. It is absolute survival. Which brings us to Section 2, Smart Money Essentials. Time to think like a bank. If you want to stop getting stopped out, you've got to stop trading like the retail crowd and start looking at the chart the exact way major institutions do. Gold, or XAUSD, is wildly volatile, and it's constantly manipulated around big psychological price levels. To survive that, you need a solid higher timeframe narrative. That means you always start your analysis on the 4-hour and 1-hour charts so you actually know the big picture direction. Your very first step on those higher timeframes is to spot the order blocks. Basically, you're looking for the exact zones where the huge financial players are quietly absorbing all the selling pressure right before a massive markup. These are your absolute key structural points of interest. Next up, you want to look for aggressive moves away from those zones that leave behind fair value gaps, or FGVs. These gaps are huge clues. They show exactly where the banks literally left money on the table. And since the market absolutely hates a vacuum, price acts like a giant magnet, eventually pulling right back to fill those gaps. Boom, those become our high probability strike zones. But here is the tricky part, and it's exactly how the trap gets set, especially with gold. Institutions will purposely create fake support or resistance. We call this inducement. Basically, early retail traders jump in and become the exact liquidity that fuels the bank's next move. Smart money pushes the price right past those obvious levels to trigger a massive wave of stop losses in a liquidity sweep, and then they aggressively reverse it. You absolutely have to wait for this sweep to play out so you don't end up as herd slaughter. Moving right along to part 3, the mechanics of an entry, where we get into surgical precision. Guys, this sequence is your absolute lifeline. Remember, with a daily drawdown of just 2%, you simply cannot afford wide, sloppy stop losses. So, once gold taps your 1-hour point of interest, you zoom way in, down to the 1-minute chart. You sit on your hands, let the early traders get tracked by that inducement we just talked about, and wait for a 1-minute change of character in your direction. Only then do you enter on the retest. That gives you a super tight stop loss so you can safely target the next major pool of structural liquidity. Getting impatient and chasing that very first break? Yeah, that's exactly what puts you on the wrong side of the smart money trap. And this is completely crucial for a small prop account. Do not trade during high-impact news like CPI or NFP. Gold reacts so violently to these data drops that bad slippage could literally blow your tiny 3% max loss limit in a matter of seconds. Seriously, just stay flat during the news. Instead, focus your trading strictly on the high liquidity overlaps of the London and New York sessions. Okay, section 4, the seatbelt of risk. Let's talk about the micro-risk strategy. I absolutely love this seatbelt analogy because it totally reframes a losing trade. It takes it from being this emotional failure to just a simple, calculated survival mechanism. For a 5K account, you need a micro-risk strategy. Forget the 1% rule. You should only be risking 1/4 to 0.5% per trade. That's just $12.50 to $25. Risking 1/4% gives you a massive, massive cushion. Think about it. You'd need 12 losing trades in a row to fail the challenge. That gives you the exact breathing room you need to handle gold's crazy volatility. You really have to view every single trade as an independent draw from a giant probability jar. One single loss means absolutely nothing to your overall edge. You maintain strict, fixed percentage discipline. Never, ever randomly bump up your lot size just because the setup looks perfect. Every trade is just one tiny green or red marble in a huge sample size. Finally, Part 5, Mastering Psychology. Time to master your own mind. The sheer pressure of a strict drawdown limit is intense, right? It almost always leads people straight into revenge trading or overtrading. But listen, your edge isn't your strategy. It's your ability to maintain a dead calm identity when the charts start going absolutely wild. You have to stop acting like an excited gambler pulling a lever and start operating like a cold, calculating business owner managing risk. Turning hope into an actual plan, an impulse into a strict process. That is exactly how traders scale up to multi-million-dollar payouts. And a huge piece of this puzzle is enforcing strict walkaway rules. If you hit your daily loss limit, you shut the laptop immediately. No exceptions, no just one more trade, no trying to make it back before the close. Just walk away. This ties perfectly into the Japanese Kaizen approach. It's all about making those tiny micro improvements in your discipline, rather than swinging for the fences in one chaotic session. Mastering the mechanics of that 1-minute entry, sticking religiously to your 1/4% risk, and having the guts to walk away when the stars don't align, that is exactly how you get 1% better every single day. Because look, the market is always going to be here tomorrow. There will always be another fair value gap, another massive liquidity sweep on gold. But when that next perfect setup finally appears, the real question is, are you going to act like a gambler? Or will you have the dead calm discipline to simply draw from your probability jar?